Corey Halliday here again with you, and today we're going to explore what is a stock split. When you think about a stock split, you think, well, okay, there's an adjustment in the share price. How does that change the company value? Is there really any result there that's beneficial to me as an investor, as a shareholder? Does it negatively impact me? Does it positively impact me? We're going to go through the mechanics of it. The short answer is it's sort of like slicing a pizza. We'll slice and dice up that pizza and make it make sense, because ultimately, whether you slice it into 6 pieces, 8 pieces, 10 pieces, it doesn't matter. It's the same amount of pizza, and we'll get through that when we talk about stock splits. So let's jump in here and talk about some stock splits that have happened in the past and some that are probably going to come in the future, and how that's going to impact shareholders in that particular stock. Now, this I think is a great example of a stock split. NVIDIA, you can see the share price has just exploded to the upside over the past few years. And remember, the share price is a representation of the underlying business. So notice the stock has gone from relatively low, $5 per share, up to $125. But in the last few years, did the share price actually ever trade at 5? The answer is no, meaning it was a $100 share price, and then it grew to 1,000. Then they did a stock split and it went back to 100. So on a split adjusted basis, well, your cost basis was down here on a split adjusted basis. Let me explain what that means. So if we come into NVIDIA and we look at the statistics on it, I'm going to click, this is Yahoo Finance, and we come down here, you can see the last split factor was a 10-to-1. The last split date was on June 10th, 2024. So on June 10th, it was a 10-for-1 stock split. Now, how does a 10-for-1 stock split really work? So here's how a stock split really works. Notice that on a split adjusted basis, it was like $5 per share back in 2020. But again, it never really traded at 5. Let's say that it was at $50 per share back in 2020. And over time, the share price obviously went up, 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 up. And by June of 2024, right in this period here, the stock was trading up at this price. Well, it wasn't at 110 per share like it suggests. It was actually 10 times higher than that. So at that point in time, the stock was trading at $1,100 per share. Okay, so you had bought it at $50 per share, and that $50 had grown to $1,100 per share. If you had bought 100 shares, your $5,000 turned into obviously an enormous amount of growth. This is $110,000. So from $5,000 to $110,000, pretty cool stuff. NVIDIA's share price had increased dramatically. Now, when it was trading at $1,100 per share, that was its share price, they went through a 10-for-1 stock split. What does that mean? It means that for every 1 share you currently own, you're going to own 10 shares after the fact. So if we had bought 100 shares here, we still owned 100 when it was up here at 1,100. Well, now they're going to adjust the share price down, but they're going to increase your share count. So instead of owning 100 shares, you're going to get 10-for-1. You're going to own 1,000 shares after the 10-for-1 stock split. That sounds really exciting. Well, here's the problem. The share price is going to be divided by 10. So there's no real benefit in terms of, there's no gain or loss. This share price is going to go from 1,100 down to 110 per share. But notice it's the same mathematically. So if we own 100 shares when it's up at 100 or at 1,100 per share, watch. 1,100 share price times 100 shares is $110,000, right? If we divide, well, let's write that in. So that's what our stock is worth. $110,000 is what 100 shares times the 110 share price were worth, or the $1,100 share price, pardon me, right? 100 shares times that share price That's how much value we have on June 2024. Then they go through a 10-for-1 stock split, so our 100 shares becomes 1,000, right? It gets multiplied by 10, but the share price goes down by 10. It gets divided by 10. So watch. After the stock split, we now own 1,000 shares, 10 times as many, but the share price was divided by 10, so now it's times $110 per share. It's still $110,000 worth of stock. Nothing has changed in terms of value. And so the way that we explain stock splits is like a pizza. If I have a big pepperoni pizza, right? We'll draw some pepperonis on here. And this pepperoni pizza can be sliced and diced as many ways as one wants, right? We'll draw a few pepperonis on there. Well, we can do whatever we want. We can have it unsliced. We could slice it down the middle. Now there's 2 slices. We could cut it into 4s, right? We could go ahead and make 8 slices out of it, right? We could go further and slice and dice it up and make these really skinny. But let me ask you a question. Did the amount of pizza we had change at all? Did we ever increase the amount of pizza? No. We're not magicians. There didn't become more pizza. It was just sliced and diced more often, right? So we can turn it into a 24 slices or 36 slices or whatever we want, but it doesn't make more pizza. It's the same amount of pizza no matter how many ways you slice it. And that's the same thing with stock splits. It does not create more value. You had $110,000 worth of stock, whether it's 100 shares times a 1,100 share price, or whether it's 1,000 shares times a 110 share price. All they simply did was reduce the share price down, but increase your quantity of shares, creating the same effect. Now, the next question is, why do companies do that? Why, if it doesn't change the value at all, why split the stock in the first place? Well, the reason is psychological. The belief is that investors are more inclined to buy a stock that's trading at $100 a share versus paying $1,000 per share. It just seems like a better value. The consumer, the stock investor, is, again, it values the company the exact same way, but shareholders, share buyers, it seems are more likely to buy stocks when they're at a more reasonable normal share price. And when they're up at a really high share price, it seems like the stock is expensive. It seems psychologically like, well, maybe that's out of my price range. And so it's a psychology thing. The belief is that, well, if we split our stock and make it a lower share price, more investors will pile in. And the truth is that stock splits are usually bullish just from the standpoint of the reason that a company's doing a stock split in the first place is because the business has been going so good. The only companies that do a stock split are companies that have had a big increase in share price, right? They went from a more normal share price like $100 per share, and they've done so well as a company that now they're trading at $1,000 per share. And so they have a tendency to split the stock, and then the share price goes up again because, again, the business is good. The business is strong. So generally speaking, companies that are doing stock splits are bullish because the underlying business is strong. That's why the share price went up in the first place. And the reason the share price is going up is because of the fundamentals of the underlying business. If we were to look at NVIDIA's earnings and revenue growth, this company has been growing their revenues and their earnings by over 100%. Doubling your numbers is very, very powerful. So what are some stocks that are maybe going to do stock splits in the future? Well, it's who has a high share price because of increasing, you know, zooming shareholder value in terms of the stock price going up a lot? Well, let's look at Netflix. Now, I don't know if Netflix is going to split their stock, but their stock is up at $710 per share. So the possibility exists that they would be perhaps likely to do a stock split because it's an expensive stock. So whenever you find a stock that has a share price that's gone up a lot and is starting to go into hundreds, maybe even, if it gets to 1,000 and so forth, some of these stocks that have really increased in share price might be more likely to do it. Tesla, it's at 254. Well, it has gone through a couple of stock splits in the past. If this share price jumps up here again and gets to 500, 600, they'll probably split the stock again. So share prices that go up, they tend to split the stock to make it more attractive to the average investor. We've explored what a stock split is. Now I want you to go and watch this video. This is an important one. It's basically how to start investing in stocks. And as we've discussed, stock splits are happening because stock prices are going up. And when stock prices are going up, the shareholders are the beneficiaries of that. It means you're making money. So how do you get invested in the next stock that's going to explode to the upside, that's going to have a stock split? Watch this video on how to get started. As always, click the subscribe button. Make sure you click the bell to be notified of the next video. Share these videos around. Hope you're enjoying the learning process. We'll see you in this next video, how to start investing in stocks.